Okay, today's going to be a little deep, and I want to continue going through the trading plan and just show you how well it's going this year. This is one of the accounts that we're trading, and we started off the year at $42,000 in this account, and we have made $3,758, 8.94%. Now, you would say that that's over 3 months. So we're averaging about 3% a month. So we're on track for 36% annual return, which with this strategy is pretty easy to do in a bull market. So let me show you how we're comparing to the price of SPY, what SPY has done. SPY started the year at 475. SPY is currently at 520. Let me refresh that to get the up to date. Yeah, 520.47. So SPY, if I had just put my money in the S&P 500, I would be up 9.5%, and I'm up 9%. So I am underperforming the market. The good thing with my strategy, though, and I think you guys will like this, if the market had been down 9%, I would still be up 9%. That's where this strategy is really strong. We kind of underperform just a little bit in a bull market, but in a bear market, we kill it. In 2022, the market was down 20%, and we were up 24% on this strategy. In 2023, the market was up 24%, I think, and we were up 20%. So we underperformed the market in bull markets, but we really roast them in bear markets. This strategy really works well in a down market. So let me go through and try to explain what my major strategy is. Now, we've already told you what delta is. Delta is the directional risk that I have in the portfolio. So, for example, my trade sheet keeps up with this. My deltas are at 62. So that means I am bullish, and it means that I have the equivalent of 62 shares of SPY in my account, directionally wise. My theta is 64. So theoretically, I should make $64 a day in profit. Well, the last time I looked, we have made $750 in a week. 750 divided by 7 is a little over $100 a day, right? So 750 divided by 7, we have outperformed a little bit. We've made roughly $107 in the last week per day. All right. So what the plan does is and then I look at my buying power. Yeah, my buying power is 13,000, which is 28% of my net leg. So 13,000 is the collateral that I have to put up to make these trades. All right. So any questions on deltas, theta, buying power? Now you'll notice that these are in red. So this is basically saying my deltas are fine. They're green. I'm not too directionally long or short, but I'm a little hot on my theta. But remember, in my plan, I can use up to 50% of my buying power if certain conditions are met. If I'm above the 200 daily moving average, and if price is the 10 exponential weekly moving average is above the 20, then I can use up to 50. And that's the case now. So I'm really under allocated and still making 3% a month. So we're on track for 36% this year, which is a fabulous return. I don't care what the market does. I don't care if the market does 50%. If I do 36%, I've done well. Remember the plan, my plan says that my goal is to make a minimum of 20% annual return. That's what we're trying to do. We're trying to make 20%. Okay. So now let's get into the weeds. And y'all, this is going to be a little deep, but I want to show you exactly what the strategy is. So the strategy involves either a 1-1-1 trade or a 1-1-2 trade. A 1-1-1 trade is what we're primarily going to focus on today. It's comprised of an out-of-the-money put debit spread. That means I pay for it. I buy a debit spread. And one out-of-the-money naked put. That means I sell a naked put. The 1-1-2 trade is comprised of an out-of-the-money put debit spread, just like the 1-1-1, and two out-of-the-money naked puts. And ideally, I like a 1-to-1 ratio of naked positions to put debit spreads is preferred. So let's just show you how we do the naked put. So a 111, I'd sell one naked put or two puts if I'm doing a 112. Okay. So I go out closest to 120 days. I wish I could tell you why. Me and my group and several others have tested all different kinds of expirations, and we really like 120 days. We like going out 4 months and selling something that expires in 120 days. So we sell one 10 delta put for the 111. So what is a 10 delta? Well, that's an equivalent of 10% probability that that option is going to be in the money. In other words, there's a 90% probability that that put is going to be out of the money, which is what we want it to be at expiration. So I'm going to open up the Tasty platform. Let me close the video so you guys can see. Make sure everybody can see this. I'm going to open the platform and just show you what it looks like. So in this account, I trade ES. So again, we're going to go out to 120 days, right? Now, if you've got a smaller account, you would trade /MES, which is 1/10 the size of ES. But this is a $200 and some $1,000 account, or 198. I forget what it is. But I just want to show you how we do this one. So we're going to go out closest to 120 days. So that could be 114 days or 126. Really doesn't matter. It's just around 120 days. So I'm going to go out to 126 days. I'm going to go over here and open the options chain. So this is at the current price, right? 53.35. So this is the puts, and I go out of the money. So I'm going down, out, away from the money of the puts. And I'm going to find something that is a 10 delta. Now, 10 delta means 0.10, but also delta is an approximation of probability of being in the money. So a 0.17 delta is approximately 17% probability that that put's going to be in the money. So I want to go out to a 10 delta put. So let's see what the 10 delta put looks like. So there it is, 10% probability of being in the money. That's the 4,700 strike. And I would click on the bid. Now, let me show you why we like this. What's this, guys? This trade has a 92% probability of profit. How about that? We bring in a total premium of selling this put of $1,538. It's positive delta. It's a bullish trade. And I get $20.59 of theta per day, right? My max profit is the amount of premium that I receive, again, the $1,538. My max loss occurs if the E-mini S&P 500s go down to zero. But my broker doesn't believe that. My broker thinks that if we put up $9,400 worth of collateral, that's probably the max loss. That's what the broker's charging me in collateral to put this trade on. Okay. And let's just see the risk profile of a naked put so everybody can see what it looks like on a graph. So let me show you this. Here's what the naked put looks like. Go to curve, go to analysis. So look at this little thing. I think you'll like this. Let me zoom out so you can see this better. I make $1,537. This is where the current price of the stock is, or the ETF, the future. ES is 53.35. And it has two numbers over here. See to the right of that, it says PLTO. That's the profit and loss today. And then at expiration, what's this? It doesn't matter how far the market goes up, I'm going to make my $1,537. See that? It just stays the same. And here's the cool thing. Look at this. I still make my $1,537 if the market goes all the way down to this break even right here, right around the 46.75. See that? That's a long way, y'all. That's a big drop. Now, what's the P&L Theo number? What's this, though? If it goes down to 5115, I'm down $812 on the position. But if it holds there till expiration, I still get my $1,500. Look at this, y'all. If we go down to the 5,000 area, I'm down $1,800. So it happens that this P&L line theoretical on today's date, this thing you could lose money early until this thing matures. Now, what happens is this little P&L graph, this line moves up, so it will eventually go into the top of the green area here. And let me just show you what that looks like. See if I can move this date on. What's this? As I move the date from, well, actually, that should be today's date, the 27th. Do you see it move up? Now, what's this as I move the dates up? What's the little orange line? It moves up. See that? It matures. The trade matures and gets profit in it. So at the very end, at expiration, this thing starts to take the shape of the expiration line. So now, if we stay here and we go down to 50, 60, look, I'm up $1,290 today. Once this has matured and the option has decayed some. So if you keep on going, then it ultimately goes to expiration. What's the thing? Take the shape of the expiration. See the P&L zero line? What's this? The O line basically becomes, boom, it becomes the expiration line. Everyone see that? Isn't that cool? So that's not the only thing that I do, though. So I sell a naked put at a 10 delta, at a 10% probability of being in the money. But I also do something that gives me a little bit of insurance on this trade, and it's called a put debit spread. Now, watch what happens. I want you to kind of look at this, and then I want to show you what the put debit spread looks like. So I go to trade, go to table, I go, and now I want to buy a 25% probability being in the money, which is this little bug here, and I push on the ask. So I'm buying that. And then I'm selling an option. This is a put debit spread that is 50 points below where I just bought this. Now, let's show you what it looks like. Make sure all three. Now, this will be the naked put plus the put debit spread. Love this, guys. What's this? Now, look what it did. Wow, waka, waka. It gives me this nice little hump to the downside. And I call it a whale. This thing to me looks like, well, let's see if I can draw here. Let me see. Draw. It looks like a whale. See that? With a little tail right there. So we got this nice little whale to the downside. Got me a little eye there, a little spout where he goes out. And I can make oversized profits if the market goes down. Wow. Now, this is amazing. Now, look, here's the problem, though. Let's go back to today's date. Today. If the movement happens too early, like if it goes down here to 49.50, look, I'm down $1,200, $1,300 today. But if the price stays here, again, that little profit curve, theoretical orange line, see, as we move the days forward, it moves up into that little area. And it matures, so to speak, so that I eventually start making wonderful profits if we move down into that little area. Look at that. So on July the 15th, if we were to go down to 49.50, look at this. I would be up on the day $2,500, and I would be at expiration. If we stayed there, I would get $3,562. Great. So this is the one trade, one put debit spread right here, plus a naked put. What is my risk? Well, this moves my downside break even farther down. Look at this. Now my break even is down here at the 46.20. See that? 46.28 is my break even. So it's a wonderful, wonderful trade. It is a bearish trade that does phenomenally well in a bullish environment. You're going to make that 1,050 regardless of how far the market goes up. And if the market goes down, you can. That's why I told you this strategy actually makes more money in bear markets than it does in bull markets. So the market could be down 9% on the year, and you and I could be up 9% on the year. So that'd be an 18-point swing, right? 18 percentage point swing. So this is it. This is the trade, y'all. This is what I do. And so what I do is I do one every week, right? I do one every week. So I basically say I want to do one of these a week, whatever my tranche size is. So my tranche size may be 2. So I would do a 2, 2, 2. If your tranche size was 3, you would do a 3, 3, 3. You would buy 3 of these. You would sell 3 of these. You would sell 3 of these. So whatever your tranche size is. And I basically say that I want to have 15 of these on. So if you were going to start this program, you would say, hey, I'm going to put on 1 this week. I'll put on 1 the next week. And after 15 weeks, you would have 15 of these puppies on, right? Then at the end of 15, you close the naked put for a profit and you put another one on. That's what we call in the business, we call it rinse and repeat. Rinse and repeat. Now, let me show you how I manage these things, because you're going to have questions and I want you to see how we're going to do this. What we do is we now have to manage the trade. What happens if price goes down too quickly to begin with and we have outsized losses? What do we do? If the market, if it did it today, you see we would lose. If it went down to $48.95 today, we're down $1,900. So we've got to have some management of the trade. Now, remember, you're going to have a probability of profit on this entire trade of 93%. Your max profit is if price expires inside this 10 area, and that's $3,500. My max loss is if it goes to 0, and the broker is charging me $8,500 in collateral of my account to put this trade on. So let's look at the management of the trade. And I'll try not to give y'all too much today because this is a lot, and this is a lot of head scratching. Okay, so we sell a 10 delta put. How do we manage that put? Now, we manage them differently. We manage the put debit spread separately from the naked put. So naked puts are usually closed at 95% profit or when they reach 30 to 21 days to expiration. Again, let me go through that again. Naked puts are usually closed at 95% profit or when they reach 30 to 21 days. Let me show you what that looks like. So in this account, I've got it bunched up by my naked puts. All my naked puts are in one thing. So let me go to naked puts. Here they are. And these are all the naked puts that I have on. You see there? Got all kind of naked puts. And I've got P&L on this. This naked put is up 96%, and it's got 23 days to expiration. This is a candidate to be closed. So is this naked put. These 4 naked puts. Look at there. They're up 95%. This is up 95%. This is up 95%. This is up 95%. This is up 95%. I could theoretically close all of these positions and take 95% or more profit. Y'all, waka, 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 waka. I mean, this is great. So let's go back to it again. So your management is normally you're going to close it at 95% profit or when they get down to 30 to 21 days. You don't want this thing to go under 21 days because you have what is called gamma risk. Now, I don't want to go into gamma risk too much, but it is the acceleration of delta is what gamma is. And deltas will really change on you, and this position can really hurt you profit and loss wise in the last 21 days. So we sell it at 120 days roughly, and we're going to close these things when they get down to 30 to 21 days. And generally, as a general statement, at about 30 days to 21 days, these things will be about 95% profit. That's how they decay. Options decay, and that's how we make money. Now, there are a couple of things that I say, hey, if the position goes against me, if price moves down quickly, I can get out of this thing for a loss. One of them is it is permissible to close the naked puts at a loss equal to 2 times the initial credit received. Well, what does that mean? That means if I sell an option for $1, and we're just using round numbers, I can close it if this thing swells up to $3. That means I sold it for 3. I bought it back I sold it for 1. I bought it back for 3. That's a $2 loss. Everybody with me? So that's a 2x loss. I lost 200% on the trade. So in this one, I was selling it for, remember, $1,500. So if I got to a point that I had a $3,000 loss on that put, I would just close it and accept the loss. Sometimes the market goes against you. 93% of the time, you're going to make a profit. Sometimes you're going to take a loss on it. Now, there's also something that is called a 30 delta breach that I do as well. If the short strike that I sold at a 10 delta becomes a 30 delta or higher, permission is granted to either close the trade and accept the loss, or to place the put in problem child status, where the debits and credits of the trade are monitored to ensure that the trade is ultimately profitable. In other words, if this put that I sold at a 10 delta, if price here moves down, if this price moves down, the delta of this put increases. And this thing might become now a 30% probability being in the money, or a 30 delta. Then what I do is I close this put and take my loss. Then let me show you what I do. So cool. Y'all like this. And then I swear, this is the last thing that we're going to go through today is management of this naked put. All right. So let's say that price goes down, and all of a sudden what was a 10 delta put is now a 30 delta put. Close it. You'll just right click on it and you'll hit close position and close it. Take your loss. And then in my spreadsheet, I have problem children. And this is a problem child that I had back in March of 2023. The initial trade, I sold that naked put for $408. I closed it for $1,600. Ouch. That was a 3x loss, ladies and gentlemen. If you get a credit of $408, but you have to pay $1,600, I just lost $1,200 on that trade. Everybody see that that's a 3x loss. So what did I do? I extended duration. That's all that I did. I extended duration. I closed that put. By rolling out in time to extend duration. Rolling is nothing but closing one and opening another in a farther dated expiration, DTE. Let me show you how that would work. Remember the put that we were going to sell today? It's a 10 delta, right? Let's see what that would have had. Let's look at it. Let's go back to the table. Here it is, $30, 10% probability of being in the money. Now let's pretend that this option becomes a 30 delta. Well, that means a 30% probability of being in the money. Let me delete these legs here so they don't get in the way. So if that becomes a 30 delta, now this option would take me $103 to close it, y'all. Remember, I sold it for $30. If it becomes a 30 delta today, it's going to cost me $103 to close it. So what I would have done then is now I go 126 days. Y'all remember $103. Okay. I would go out another 30 days. I would close this put, and we're pretending it's here now for $103. Then I would go out probably another 30 days. So from 126, I go to about 156. And I would sell something for $130. What could I sell for $130? I could sell this put for $141, right? So I basically rolled the put out to a 52.50 and a farther expiration And in doing so, I collected an additional credit. So in this case, I closed it for 1606. I went out farther in time and sold another put. And I made sure that the credit that I got was equal to or greater than the debit that it took to close that put. In the meantime, that put debit spread that I bought, remember the 50-point wide put debit spread? Well, this was in the micro E-mini, so I was able to close it and get a $200 profit. And the market calmed down. This naked put that I sold or rolled eventually decayed, and I bought it back for $411. So here's what happened. Initial credit cost me $600 to close it, which resulted in a $1,200 loss. I rolled the put out and collected a credit equal to what I had closed that for. I closed the put debit spread for a $200 profit. That brought in a credit. Then I eventually closed this rolled put that I moved out in expiration. It decayed like an apple decays that you take a bite of, and I was able to close this for $411, such that my total debits were 2017. My total credits were $2,200, equals a profit of equals this minus this. $200.19. That's how you do it. That's how you do it. Now, what if price had continued to move against this put and it didn't decay? It swole up again. I would have rolled out to a farther expiration. I have basically punted the ball. I've taken my loss of $1,200, punted it 30 days out, collected an additional credit in hopes that it would decay and I would ultimately make a profit. So I took a $1,200 loser and turned it into a $200 profit. Well, Bobby, you're telling me that's easy to do? Yeah. Now, if price kept moving, what would I have done? I would have said, okay, I got to roll it out. If it comes back here and it gets closer to this, instead of a 52.50, I could have rolled it out maybe to 200 days. Look at this, y'all. Remember I said I got to sell something for about $130? I could have rolled it out to the 51.50. Instead of the 52.50, I can roll it out to the 51.50. I'm moving the baby away from the heater. Here's the little baby and his little thing. Here's the heater with the fire. The fire starts moving toward my baby. What do? You move the baby farther away. When the price of the E-minis gets closer to my price, to my strike, all I do is move him out in time. I make him safer. Now you say, well, Bobby, how far can you roll it out? How far do I need to go? Look at this, y'all. We've got 205 days. We've got 330 days. We got 449 days. We got 540 days. I could have rolled him out over multiple years, y'all. I mean, I could have rolled him out over a year to the 540, right? We needed to bring in $130. I could have moved it all the way down to the 4,500. So that I've made him very safe. Look at there, y'all. The market would have to drop. $1,000, right at what it is, $800 or so. Isn't that right? 5, 6, 7, 8, yeah, $800. It'd have to drop. The market would have to drop $800, and I could move him down to the 4,500, and he'd still be safe. Now, to do this, it takes buying power. So it takes buying power. This is why you can't say, "Oh man, I got a $100,000 account. I'm going to buy, I'm going to sell $100,000 worth of options." No, 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 no. You don't need to sell more than $50,000 in options because it costs cash to move these positions. You're going to take temporary losses. And I need that cash sitting on the sideline in order to roll this puppy down and out. Roll the baby, put him in a little cart with wheels on it. I got my little baby in here. Got the heater with the fire. I roll him out. And if the fire keeps going, what I do, I roll him out a little more. And roll him out. Isn't that great? Now, y'all, I was not going to go through this today, but Matthew, who is in our class, he has decided that he is going to conquer this stuff and wanted me to keep going through the plan. So that's all I'm going to give you today. About 30 minutes of this is all you can handle. Now, I will say this. If anybody wants to, I will be trading this live tomorrow with my University of West Georgia class. So you can actually see me put on trades tomorrow. Right? We're up $56,000 on the year in all of these accounts. I will actually put this trade on tomorrow and you can follow along with me. If you are interested in that, just give me a thumbs up or whatever, and I will give you guys access to that Zoom link tomorrow at 2 Eastern time, 1 Central time. Okay, Jason, you want to be a part of that? And I will actually put on the trade. We will actually go through the process of putting on the trade, doing the metrics, going through the entire thing so that you'll understand what we're doing. Y'all, profits of $56,000 this year, that ain't bad. That ain't bad at all. On 600 something thousand dollars of capital that we've got here, we're up $56,000. This stuff is amazingly fun. It's amazingly fun. Now, remember, I do not want you doing this with your retirement money. You're putting 10% of your retirement money, and if you get a match, you're doing that into BOO or the SPY, S&P 500. You're sitting and forgetting it, and you add bonds 10 years from retirement. That's what I want you to do with that. This is what we call fun money, baby. All right? This is where we do fun money. If you can make 20% a year, you are among the world elite traders. And I think it's very possible with this strategy. I have given you a golden goose that lays a golden egg. It's up to you if you want to figure out how it works and to get into the nitty gritty of it. So I will send that Zoom link out. We will meet tomorrow at 1 Central time, 2 Eastern time. Okay, for anybody that wants to join. Anyone got any questions before we cut the day off? Any questions at all? Okay, if not, I will see y'all tomorrow or next Wednesday. Y'all be good.